That's the one downside to these index funds is that people don't think of them as corporate ownership, because what you should say is, hey, if there's 1,000 shares out there, I'm not buying a share of stock. I'm buying 1/1000th of this company. Would I be happy paying $1 million to own the whole company? If yes, then I should be happy paying $1,000 to own the stock. And if you'll sell it to me for $500, I should be thrilled, to take advantage of you in that way. Why not try and take your volatility down by going into other asset classes that have high expected returns, but just a different risk profile? So, litigation finance being a good example.
All right. So one question I have for you is, in light of where we're at right now in the economic cycle, I mean, there's a lot of things that are kind of signaling that the markets are going to slow down, that the economy is already slowing down, unemployment's going up. So when you're doing your peer-to-peer groups and you're meeting with these high net worth individuals, what kind of preparation are you seeing them making to get ready for what could be coming? I'll let you unpack that, but I got so much more on that.
Yeah, that's a fantastic question. I mean, I would say first, I don't think anybody knows, some secret thing behind the curtain. I think all of us today, there's been this great information equalization with AI and, other tools like that. So I think there's not some magic set of data behind closed doors, but to your point about, hey, what are people doing to prepare? What are they thinking about? So a couple of thoughts there in terms of what people are focused on. I think it's a lot of the same things you've been seeing out there of, hey, obviously AI is a growth engine. That's, if you can get shares in Anthropic, that's great. I think there are some things, some particular asset classes that, software as a service, clearly, and related to that, private credit, that have seen a lot of degradation, probably down 50%, depending on, maybe private credit. You've seen some portfolios go down 25%, which is actually a huge drop when you consider that's, not on an equity position, but on debt position. And if you think about, software service equities, down 50%. So I think people clearly looking at those and asking the same questions everybody else is, hey, is this overblown? And, NVIDIA at 5 trillion, can it really go up from 5 trillion to 10 trillion? But, in terms of preparing their personal portfolios, I think one thing that's really interesting, and this is not specific to this moment in time, but a general approach, we do this annual benchmarking survey, asset allocation, where we ask all of our members, hey, across 60 different categories, whether that is different kinds of public equities, different kinds of alternative asset investments, real estate, et cetera, how do you allocate your portfolio and what kind of debt do you take on? People do two things, which may seem contradictory, but actually kind of make sense. One is they hold very little in the way of debt or bonds. People are not interested in saying, hey, I'm going to own treasuries at 4 or 5% and lock in that return for long term. They want equity-like high return instruments. But on the same side, or on the flip side, they're much more conservative with leverage than you would expect. So I think your typical member has maybe 10% of their net worth in debt, and that includes mortgages. So if somebody's got $10 million, maybe they owe $1 million on a house. So they've got 11 million of assets and 10 million and 1 million of liabilities. So and maybe half people have no debt, very conservative debt position. And I think that is what allows people to then take a more aggressive equity position. So, in short, most people say, hey, I'm not going to try and time the market. I'm not going to panic sell or not even panic sell. I'm not going to sell the S&P at an all-time high. You couldn't really call it panic sell, but I'm not going to sell the S&P today on the fear it may go down, but I'm not going to take on aggressive leverage. So if it does go down, I'm then forced to sell at the bottom. So I'd say it's probably a continuation of that approach of being invested in risk assets, but then having a conservative debt posture.
Well, you brought it up, so I'm gonna go into the treasury bond holdings because it's not really exciting to get 4.5% in a treasury bond portfolio. But when you look at Ray Dalio's all weather portfolio and the changes he's made over the last few years, or not so much him, but his former company, and then also Warren Buffett and his massive cash position, which is largely T-bills and treasuries. Do you think that they're looking at that not just as a hedge or just as a risk off asset, but also looking at it from a price movement standpoint, with rates where they're at? And I think it's pretty safe to say that we're probably going to see lower rates in the future. When, we don't know, but there's a lot of speculation there. But if rates are to go lower and the economy was to soften, then there could be substantial price movement in the price of these bonds, especially the long dated bonds. Like, what are your thoughts to that strategy?
Yeah, I mean, I don't, want to claim I know more than Warren Buffett about investing, or kick me off this show right now.
Definitely not.
But Yeah, I think you're right. One thing I've learned is not to outguess the market. If the market says this is the fair price for stocks or this is the right futures curve for treasuries, I could be taking a guess on that, but I'm only taking a guess. But I think if you look at what Warren Buffett's doing, I don't think he's holding that cash because he expects rates to drop by 2% and then see, a 10% appreciation on his treasuries. I think if you listen to what he says, what he's doing, and it's not just him, is hey, markets go through cycles. He's been through 10, 20 crashes and, he's hoping he'll make it through another couple of crashes, but he knows there's another one coming. So I think he's holding those hundreds of billions of dollars for the next time there's an '08 and he can, come to the rescue of Goldman Sachs like he did, or Occidental Petroleum or whatever it is. I think he wants to buy something at a discount, and more credit to him that he can track the market while holding a third of his assets in cash and then have that option. I think, if I could have that option, I certainly would like to do the same. But I think it's not just him. I was listening. My wife works at Capital One, so I was listening to their earnings call yesterday. And their CEO, super impressive guy, Rich Fairbank, he founded the company 40 years ago and still a very hands-on manager. And some of the analysts were asking him, like, "Hey, you have too much Tier 1 capital. You're way above Basel minimums. Why don't you do more return to the shareholders?" And what he was saying is, there are moments, and we don't know when they're going to be, but there are moments when having capital in hand is uniquely advantageous. And so I think whether you think of it as an operator like a Capital One or investor like Buffett, I think the reason that they're holding that cash is because I don't think stocks are wildly overvalued now, but it'd be hard to call them particularly undervalued. So they'd say, okay, I'm going to wait until they really are up undervalued and then put that cash to work. And you could argue that Buffett's been doing this wrong, right? As much as I said, he's the best investor out there, but he would have been better off that cash that he's been hoarding for the last 5 years. If he'd had that in the market,
100%.
Berkshire would be better off today. If I look at what some of our members do about this, and they're saying they don't want to hold cash, what a lot of them do is try and build up large flexible lines of credit where they say, hey, I'm nowhere near maxed out on my borrowing capacity because I'm not holding on a regular basis. But if somebody has a $5 or $10 million portfolio, and then they have the ability to borrow, let's say you're allowed to borrow up to 75% against that. You don't want to get a margin call. So maybe you're comfortable borrowing 25%. That means you have $2.5 million of dry powder that you could comfortably deploy. And so then that's pretty much as good as having $2.5 million in cash, that if there's a crash that you can put it to work, but you don't have any of the cash drag because that's just sitting there as a line of credit that you can tap in the future. So I think a lot of people like to maintain those for the option value.
That's a good take on that. I've been through so many different cycles, not nearly as many as Buffett, but, as an advisor, I've gone through a few recessions, and then also just as an investor. And, I guess I'm just at the point now where I just don't want the risks. I can invest in companies, my own companies or other people's companies privately. I can do private lending and, clip off 12 to 15%. So I've definitely, when I really kind of studied your stuff and what you and your group do, which we'll get into in a second, I really love that the way you look at equities and the way that you're looking at stock, is you're just taking ownership in the company, which is a really good perspective. And when you said that, it dawned on me. I'm just like, people don't really think that way anymore. They really don't look at it the way that you do. So I want to unpack that a little bit, because I think sometimes so much of the decisions we make, mine also, that's why I kind of started with my, risk off approach right now, or private approach, is, I've just kind of lost my way with equities. I've just lost my way with stocks. And I think a lot of it just comes down to mindset. I've gotten beat up in prior recessionary periods, and now I've got the means, and I'm kind of just like, hey, listen, I'll take a lower return for less volatility and less headaches. But can you just talk a little bit about the way you look at stock and how, it is what it is, that you're taking ownership in the company? So kind of back to Buffett, not to keep bringing him up, but that fundamental approach of looking at a company saying, hey, can this company improve? You mentioned NVIDIA, but just like your mindset around that was fascinating to me.
Well, I really like reading Buffett's letters because I did not come up with this. This is cribbed from him. He says that being an investor makes him a better operator of companies, and being an operator makes him a better investor. And so I do think, I love this boglehead, passive index fund revolution where people say, okay, I'm going to pay 10 basis points or 5 basis points to get an S&P index. I think that is a really healthy way to invest, but I do think the downside of it is it creates this disassociation. You just see the thing you own as some ticker symbol, SPY or VTSAX, and that doesn't mean anything. As soon as you see that thing start to crash, you start to panic because you're like, well, I don't actually know what this is, and I don't particularly want to own it. I'm only owning it because I think it's going to be worth more. But as you're saying, if you're, Buffett talks about Coca-Cola, it's like, I am happy to own Coca-Cola. And if Coca-Cola goes on sale tomorrow and I can buy the company at half the price, I am a much more eager buyer because I know nothing bad happened to Coca-Cola or to ExxonMobil, that it still has all those oil fields are still out there. They're still pumping, they're still selling, and I'm just getting a cheaper price. So I do think that's the one downside to these index funds is that people don't think of them as corporate ownership, because what you should say is, hey, if there's 1,000 shares out there, I'm not buying a share of stock. I'm buying 1/1000th of this company. And so, would I be happy paying $1 million to own the whole company? If yes, then I should be happy paying $1,000 to own the stock. And if you'll sell it to me for $500, I should be thrilled, to take advantage of you in that way. I'm curious though, one thing you say that you've gone to a risk off position. It doesn't strike me if you're doing private lending at 12 or 15%, is that really risk off? Or are you just taking a more diversification approach and saying, okay, well, I've got a set of my money in equities and they have this risk. And then I have a set of money in private credit, which maybe has a similar expected return of, say 10%, but it's a different and imperfectly correlated set of risks. Are you just looking at as diversification, or do you think you've really taken down your kind of total risk profile?
I've definitely taken my risk profile down. The private lending, I was really heavy on that. I got beat up a little bit on that, but it was outweighed because you're getting such a good payout. It doesn't, you can weather a couple bad ones. But really, what I was referring to is I've been buying treasuries. I've been buying them the last couple of years. When rates started going up and the price was driving down, I just started buying, and I just haven't stopped buying. And I've really bought no equities, zero. I've invested heavily into a bunch of incubator companies and a bunch of my own companies, which I can kind of control that risk. I got a really bad car collection habit of Porsches. That's been a really bad thing, but I finance them all. Like I go to wherever I'm going to buy it, I look at the car and I say, okay, this car would cost me X amount per month if I were to finance it with XYZ bank at 6%. So then what I do is I just structure the note and I pay myself or my private banking system back the exact same interest rate I would pay a bank. So it's kind of like guaranteeing myself a return on my own money, but it's to buy an asset that I truly think will go up in the future. And I know a car is a terrible asset, but when you got a passion for them and you like them, it's just kind of, it's a dialing down of the risk, but it's also, I guess it is kind of diversification. I never looked at it like that.
Because I guess I wonder, there's, if you're an investor, you've got public equities are an option out there, and you've got bonds, and everybody has access to those too. And most people probably have real estate access, right? Because you can buy your own home. So you can at least get that piece there. But if you're in a position where you can be investing as incubators, I guess I'd ask you, like, why not try and take your volatility down by going into other asset classes that have high expected returns, but just a different risk profile? So, litigation finance being a good example. I was actually just talking with a guy today who does litigation finance. And, historically, the returns have been eye-wateringly good, 30% plus IRR. Well, let's say that's not going to happen because it's a more mature market. So you're not going to earn 35% returns. But let's say you could earn 10% returns. The risk profile in that, it's not that there's a recession, it's that you're going to lose a lawsuit. And so that is a real risk, and you're being compensated with a return. But if you buy enough of them, you're kind of diversifying that risk. And, it's not correlated with the S&P, or there's other things, like, macro hedge funds or, quantitative trading funds that are just doing trend following. And so they're not net long or net short on the index, but they're just doing trend following. And so they, again, historically have, 10 or 15% return and very high volatility, but different volatility. Why don't you kind of, in this Ray Dalio approach, say, hey, I'm going to go into a bunch of things with good equity-like returns that are imperfectly correlated and try and mute my volatility without sacrificing that returns that I'm giving up in treasuries?
I absolutely love that approach. And the reason, in what you had mentioned, like I've looked at that. Matter of fact, kind of interesting story. Might as well air the laundry here. Years and years ago, I mean, I'm going back 5-6 years ago, I was really close. I wasn't invested in it, but I was an arm's length away from a Ponzi scheme, and it's still going. It's in receivership and settling now. So the investors that did invest into this Ponzi are actually going to get all their money back. Very unique situation, really good receiver, and also a lawsuit against a very large bank whose name I'll leave out that went through on a settlement is going to get all these investors back. But I have literally watched this entire thing unfold, and that's exactly what it was. It started off as a company where you were basically financing these litigation cases, these lawsuits. And their whole thing was, you invest with us. The returns were really good, which is why I was looking at it and why my friends invested in it. That's why I was so close. It's one of my best friends in it. So he's kept me play by play. And then the whole thing kind of came crumbling down. I'm sure it started as a legitimate business, but it ended up just getting out of hand. And it's a big one. It's like tens, or actually, I think it's hundreds of millions of dollars. But nonetheless, I think that's why I haven't looked at that space. Just because when you hear about something like that, you get a little spooked. And I'm a creature of habit. I've been doing this a long time, and I just invest in things I know, like, and understand. So I really didn't understand it enough to get deep into it. Or real estate lending, what I've been doing for a very long time, I fully understand that. I understand the risks. I understand how to mitigate the risks. So it's just a comfort zone, but it does hurt me. I'm not gonna lie. Listen, I'll tell you and everybody else that's going to watch this episode, I have given up a lot of money and potential returns that I would have earned had I just followed the markets, had I just followed what everybody else was doing, but I didn't. I went off on this deviated path in things that I fully understood that made me feel warm and cozy every day, that I wasn't going to lose money. And that's just where I've stayed. And, it's why it's good for me to talk to folks like yourself. And I probably should, we got to talk about your group, because it's fantastic. I probably should get around other people that think differently than me. I've kind of insulated myself in this little bubble where I do what I do. I've done fairly well with it. The treasuries are kind of something I've always understood, and just poor. I'm boring. That's the best answer I can give you.
I mean, I would agree with, the thing that I think you're really right on is in these private markets, you do need to know what you're doing, or you need some access that you have confidence in. Because I think one of the great things about public markets is you can literally just pick 30 stocks at random. And if you buy those, you are going to get almost exactly the S&P 500 return, because there is perfect information. You've got these regulatory bodies like the SEC who are punishing people for, insider trading. You have this whole infrastructure of price discovery that, means that you will get the market return, and you actually don't need to be that careful. As long as you don't have bad personal habits of panic selling, if you just ride the returns, you'll do fine. That is not true in private markets, right? Like if you buy 5 random litigation finance things, or worse, if you just go into 10 VC funds or whatever oil and gas salesman calls you up and you answer his call, you're going to get terrible returns there. But I think the flip side of that is if you actually are able to do the research yourself, or figure out, how you can get access to these. For every person who's getting below market returns, there's somebody else, the kind of smart money, getting above market returns in those asset classes. So I think you got to be willing to put in that work. And your point around I've learned over time that one of the key things is it has to be in a larger, more reputable. There's sort of a sweet spot there where I don't know that you want to get into a manager that's managing 50 billion of assets, because then you're just kind of basically a shadow public equity portfolio. There's not that much alpha there. But I also would be very hesitant at this point to go into anything with it's maybe under 500 million or $1 billion of assets for a manager, because I think all of those cases you hear about of these, maybe not all of them, there's the occasional just, Bernie Madoff who's a super scammer, but the vast majority of them are these ones who are managing 10 million or 20 million that you really can run a scheme there. And the SEC is not, they're not trying, but they got to focus on the big boys. They can't be focusing on every little person raising friends and family money. So I think it's not the whole answer by any means, but one of the pieces you have to look at is, I think, having a relatively high floor in terms of the ones you're going with. And, probably I'd say also, unfortunately, it's like that Groucho Marx saying, I would never want to be part of a club that would have me. I don't want to be investing in a fund that would take me as an LP. Like if anybody's emailing you or cold calling you, you can almost be sure that's because the smart money in that asset class passed on that particular opportunity. And that's why I, as a dentist, am now seeing this opportunity to invest in oil and gas. That's because all the real oil and gas guys did pass on that opportunity. So now somebody's pitching me the tax benefits. I think you got to figure out a way where you are investing alongside kind of institutional endowment kind of money, and you're not investing alongside other, retail money, is to use the industry pejorative.
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action like so many others have by going to privatemoneyclub.com and sign up.
Larry, so I'm going to kind of pivot a little bit, and I'm just going to talk a little bit, I want you to talk a little bit about your past. You had an exit, okay, on a SaaS. And I think that kind of, you had the exit. And what I really am interested in, because I'm setting my companies up right now, my enterprise up for an exit in the next 3 to 5 years, and it'll be a large one. So I know my thinking has to change. My thinking can remain the same today because I don't want to say I have an unlimited capacity to just keep reinvesting back into my companies and, get a pretty predictable return. But eventually at the exit, I got to figure things out, which long angle, your peer-to-peer community you built is exactly probably what I would need at that time. But talk a little bit about, life just a little bit before the exit, with the SaaS, and then you exited. What changed? And that, like, those changes, are those what kind of led you down the path of creating Long Angle and this peer-to-peer high net worth community that you did? Because that I think is definitely the direction I need to start looking at.
Yeah, that was definitely what led me to start this community. So in terms of what changed, as an entrepreneur, I'm sure you can identify that. So the software company, it was 10 years to the day from when we started to when we closed the acquisition. Say probably the first 7 or 8 years, that was just unmitigated stress, right? Like I was not paying myself, or I was paying, we'd have days when it was, you got, a week worth of payroll left in the bank account. And, maybe for the first year or two, that's funny because you can float it. But then we've got 75 employees being like, hey, we don't have enough money for payroll here. I really hope that check comes in, just incredibly stressful. And I think there was an added layer of stress because we were running a software company that was a growth company. We didn't take any VC, so we didn't have any kind of set of capital to fall back on. But then the valuation of that, it's effectively what's your revenue run rate times your growth rate. And so there was always, not only was there's existential fear of we have to make sure there's always enough money in the bank, but you also always have to be growing. You always have to be growing faster and faster. Because let's say we were at a 5 million run rate and growing 40%. Well, if next year I only go to 6 million, even though I've grown 20% and the company's 20% bigger, it's actually less valuable than it was before because I just cut my growth rate in half. And so we grew about 50% a year, but that just became, that treadmill was harder and harder to stay on to maintain that growth rate. So that was part of the reason we ultimately sold it. Is just, it went from this, hey, this is a great learning experience. I'm shortly out of college. I'm working with my friends. One day we woke up and like, hey, I started with 2 friends. 99% of my net worth is in this one illiquid microcap company. Like this is not responsible. Like I need to ring the register here. And I think if we waited longer, we would have made more money, but no regrets of saying, okay, let's call this a win. Let's take the stress off. Let's, level up here. And then, I've got plenty of time to start another company if I want to in the future. But then what that transition looked like was, I think from a personal finance perspective, it went from not really focusing on it to it being an important thing. Prior to selling it, I thought about it in the way that anybody would of, okay, I got to, make sure I'm not running up my credit card bills. And I, if I want to buy a house, I need to make sure that, there's enough income to cover that. But investing was more of something I found interesting rather than actually going to move the needle on my finances. If I got a 12% return or an 8% return on my portfolio, that was just, not that many dollars compared to how much I could earn in salary. But when you have this liquidity event, all of a sudden you cannot earn a high enough salary to overcome poor returns in your portfolio. And so, if you go, let's say you sell your company for $20 million, if you're in a 5% return, now you're making $1 million a year. Now, if you can jump that to 10%, that's another $1 million a year. And so that then becomes a much more important thing to think about. And then, of course, the emotions become harder because you say, hey, maybe I'm somebody who's comfortable with volatility. At least, that's what I would say. But if you're doing that volatility with a lot more zeros there, seeing a number go up and down in the hundreds of thousands of dollars a day, it's just a lot harder thing to, hold on through a COVID drop than it was when you're seeing it go down by hundreds of dollars a day. Fortunately, I think I've turned out to be right that I'm fine with the volatility. So even though COVID was post-selling the company, it actually didn't really bother me that much to see the portfolio cut in half. I, had conviction, hey, these companies are just as good as they were before. So providing world comes back at some point, companies are going to do fine. And
the key thing, I don't mean to interject, but you just said something that I really need to kind of just pause on is you believed in the companies. And that's key because that goes back to that core belief that I listened to you talking about is you're buying stock because you're taking an ownership position in that company. And therefore you believe in that company. And that I think is what you had said earlier, what people have lost with indexing, right? That you don't really have any tie to any company. You're just like, oh, I'm investing in the S&P or the Dow or the NASDAQ, whatever it is. So you're disconnected from what you're actually investing in. Therefore, when one little thing happens and the market goes down 10, 20%, it's just, you just flip the switch and you're out because you have no emotional tie or really no knowledge of the company you're investing in. But you just hit on that you believed in the company. So you're down 50%, but I believe these companies are fundamentally sound. And this is just a,
Yeah.
little
I
blip.
mean, I'll
And
give you
you're right. You're spot on.
I'll give you a concrete example of that. I live here in Dallas, so I know a lot of people in the oil and gas industry. I'm not personally there, but I've become interested in it. And I remember prior to COVID, I'd bought some Sunoco shares because I'm like, hey, seems like a solid company. They're in their business is actually, it's not in drilling. It's really in distributing gas to gas stations. So they kind of run these tankers that send the refined oil, gasoline out to gas stations. I'd owned it for a long time. And during COVID, it just went absolutely plummeted because nobody was driving. So it got to a point, it was paying a 25% yield. And I said, you know what? This company's fine. Like, I know the management's fine. They're well run. And at the moment, no one's driving. Unless I believe that people are never going to drive again, this pandemic is going to last forever and cars are a thing of the past. And, in that world, I'm going to discount that world. In any other world, I'm getting my money back in 4 years on this. And so I said, all right, I'm just going to buy a bunch more Sunoco now, because that was not a ticker SUN. That was, hey, this company, there is some irrational actor out there who's selling me these things at pennies on a dollar. And, not surprisingly, it spiked back up very quickly. And so not that I backed up and truck as much as I should have. I'm not claiming I made some, 7-figure investment there and a genius. But I feel like that's a tactical example of some of these things do irrationally go on sale. And I mean, in the oil industry in particular during COVID, it was crazy. There's this company called Permian Resources. I think it's now at $50 and it was at like 23 cents during COVID. It just, everyone traded it like it was literally going bankrupt. And maybe there was more risk. Like Sunoco, I knew wasn't going bankrupt. Maybe Permian Resources was going to. But if I put $500 there, you'd have $100,000 or something crazy like that today. So I do think that's critical. But to get back to your question of, okay, how'd that lead to starting this community of Long Angle? It was really because after the sale, I tried first I'm going to go talk with Goldman Sachs and Credit Suisse and say, hey, what should I do? I've got a bunch of new questions that I didn't have yesterday of, how do you think about raising kids with wealth? What are estate taxes? How do I think about managing estate taxes, or what are alternative assets? And my concern was that I felt like a lot of those questions I could ask, dad next to me at a soccer game, like, hey, how do I set up a 529? He's going to be able to answer that. But you can't ask him, hey, how do I think about estate taxes? You're going to kind of alienate the person and you're not going to get a good answer. So I felt like, your Goldman Sachs was the right answer. But then it felt like I'm not getting unbiased information. It was just constantly, are they giving me this answer because they want to sell me something or because it's the right answer? So I basically set this up to be a group of other people in a similar situation, whether that was because they were entrepreneurs or high paid executives or running hedge funds or, something like that, where we can have peer-to-peer advice. Nobody's selling each other anything, but we're all in the same situation as kind of first generation wealth creators.
I think that's fantastic, because when you're in a group that nobody's there to sell, everybody's doing well. Everybody's of means, right? So nobody's there to sell you anything. Everybody's just there to benefit from a pool of knowledge. And did I hear you say you have thousands of members now, right? Like 3,000?
We got about 8,000 members actually. So
8,000. Wow.
8,000, which
that
I
podcast must have been old.
I started this, as I said, with my co-founder from the last company. We said, hey, we both have this problem. So we got a dozen of our friends who were like, okay, so-and-so started a hedge fund, so-and-so sold his company. And really it's been entirely word of mouth since then, of people just saying, hey, this guy from my board, my co-founder, my brother. Most people have sort of 2 or 3 peers in the same situation who they bounce ideas off of. And so they want to bring them in to kind of get that wider network. So yeah, it's grown to about 8,000 over the last 5 years.
That's fantastic. So talk a little bit about Long Angle. Like, how does one find Long Angle? How do they get, I guess, to become a member? Because I'm sure you don't just like open the door and say, hey, anybody that wants, come on in. I think that would be contrary to what you're talking about. So how does it work?
Yeah. So most people find us, as I said, through, somebody who's already a member. But if anybody listening here feels like it's for them, if you go to our website, longangle.com, we get the other half of people finding out about us on a podcast or something like that. And then if people are interested, we don't charge a membership fee, but as you said, we do have an interview process. So if you click apply there, it will basically set you up with an interview with a current member. And we probably have, 40 or so current members who act as kind of our interview team, just as volunteers, because they want to, get to know interesting people and curate who's in the community. and just sets you up with a half-hour call where you can, share your background and also learn more about the community. Because I realize how I'm describing it now seems pretty opaque. Somebody may not be sure, hey, why do I want to be in here? Hey, if you're not charging me any money, am I the product, et cetera? But that's our process. We do have a minimum net worth validation there. I would say that our typical member is probably between $10 and $15 million of investable assets. Community overall, I think, tends to be most helpful for people probably in the 5 to a couple $100 million range. I find that people below that threshold just a lot of the topics that come up are not necessarily, as relevant to them. So like estate tax is a great example. If you're going to pass away with under $30 million, you're not going to pay the estate tax. So like, don't worry about it, which is the advice you'll see in, mass media. And that's great advice. But once somebody, even if they're at $10 million, that's way below 30. But if you get to $10 million by the time you're 40, you are very likely going to be over the estate tax limit by the time you pass away. So it's something you need to start thinking about. And then the flip side with people, we've got a few people who are billionaires, but a lot of it, the questions that come up, they're just kind of like, well, I've got a guy for that. Why am I thinking about flying first class if I've got a private jet, that sort of thing. But in that whole, 5 to 100 million, 5 to 200 range, it's a similar set of questions of how do I raise kids with wealth? How do I think about allocating and managing my portfolio? Different questions around travel, things like that.
How often do taxes come up in that group? Because I mean, that net worth range that you just gave, that's a direct hit for lots of tax issues. And that's where I've been. And, over the last couple of years, I've had to pay way too much in taxes. I had to figure the tax game out very quickly, but I've made a lot of mistakes on it. And you had mentioned oil. So I do want to bring this back to oil because obviously oil can be very favorable from a tax standpoint. And I got into an oil well and it, never performed. So it was very speculative. I got the tax write-offs, but I lost all the principal. And now I've got a good operator that I do invest in mostly for tax reasons. Because the way I look at it is say, okay, I'm going to put money into this. I'm going to get these tax, benefits, these tax deductions, which are going to equal this return if I were to invest this money elsewhere. So that to me, even though it's speculative, is just a better play. But does that come up a lot in your group?
Yeah. Yes. Taxes come up a lot. I'd say one thing that hopefully will make people feel better. I'd say 80% of people feel like they are the one sucker actually paying their taxes. And I think, just the way the government works, they got to get money from somewhere. The place the money is with the wealthy people. And so, your person, let's say you're a senior engineer at Google making $1 million a year. Almost all those people are really just paying their taxes and they're not loving paying, $300,000 a year plus 100 to California. But that's just sort of, what happens. I do think there are, a few ways to optimize there. It's very easy, I would say, to optimize capital gains taxes or investment income. There's a million things you can do, whether that's different insurance structures, different asset classes, direct indexing, exchange funds, et cetera, that you can do there. If you're talking about real W-2 income, I think it becomes a lot harder. Some people go to an extreme, which I would not recommend to anyone. And I think it's going to come back to bite those people of you just get into these, unethical and frankly, illegal charitable deduction things where you say, oh, I'm going to put 100,000 into this, made up good. I'm going to turn around and donate it and say it was worth 500,000 and take the tax write-off. And, because some CPA told me it was okay, I'm going to do it. I've seen, fortunately, 99% of people see that and realize it's a scam and don't do that. Some people are sort of so philosophically opposed to paying taxes that they go through those charitable deduction schemes. And, the IRS is going to get you, as much as their staff has been cut, I think they're still going to catch up to those eventually. So I would not recommend that to anybody. And then there's kind of this middle ground of like real estate is probably the big bucket where that's the one class of member, I'd say, the people who make money in real estate who really do not end up paying much tax. And we could argue whether it's good or bad public policy. I'd probably argue it's bad public policy, but it is the way that it works of, you can get real estate and professional status and basically wipe out all of your income. And there's various things you can do there. So I'd say that's probably the biggest exception. Then there's probably some people who really like to go down the rabbit hole. Things you're talking about oil and gas or like solar credits or things like that, which those are legal. They are ethical. They're kind of weird and they're hard to manage. And it's kind of a moving thing. Like opportunity zones were big for a while and now they're phasing out. Solar credits are phasing out. So you got to kind of stay leading edge and you got to make sure that you're on the ethical side or the legal side of that divide. There's a bit of that, but I would say probably most people, to be honest, just end up paying their taxes on their income. and then trying to optimize on their investments. And optimizing could be a lot of things. It could just be buying and holding stocks. You don't have to do anything fancy. Until you sell that stock, you're not paying tax. So that's like a pretty easy way to avoid taxes. Or again, it could be things like insurance structures, which most insurance structures I'm not a fan of at all, but there's a few like private placement life insurance in particular that actually has a very low fee drag and very high tax benefits. There's a few there. Direct indexing, again, being another example, that throws off a lot of, paper losses.
That's awesome. Now, because I apologize saying 3,000. I watched a podcast you did. It must have been older. I didn't look at the date, and you had 3, but now you're much higher than that. So let's go back to kind of in the final segment of this where we began. I'd asked you about kind of the economic cycle that we're in, and I loved your answer. But going, and seeing all the things. I mean, people like myself and a lot of our community are looking at all the signs, just the things. You can't time the markets, but you can definitely see that some things are going on. I mean, private credit freezing up, which I guess we kind of probably all should have saw that coming a little sooner than it did. But you got private credit, you got the inverted yield curve, you got all these telltale signs, spike in oil. And if you go back and you study history and you look at all the other recessionary periods and what took place before, it's really eerie. And I think that's kind of where I've gone more, risk off or just, wider diversification in asset classes that I fully understand. But what advice or what would you say to the people in your group or just the people listening to this when they're seeing all this stuff, but yet, they still want to keep investing because they have to, but they just don't know where to go because they're just scared. I don't even know if it's fear, but it's just, you can't ignore the signs. And it's just kind of like, okay, do I sit back and wait? Or do I just stick to, pick a strategy and just stick to it?
And it's also surprising because, if a recession happened, yeah, you could give me 10 reasons why it's obvious it's going to happen. But I feel like that's been true for several years now.
Seriously, you're absolutely correct.
Taking these hits, and it keeps not actually translating through to a problem, right? Like people keep spending and, even more.
You're so right.
But again, I was looking at the Capital One earnings call, no insider information, but just heard it. Like their losses are not ticking up and, they're lending to subprime people. So for some reason, I think the one thing we have I don't know if it's the only one, but a significant thing in our favor is the financial system is very well capitalized. And if you look at like the Great Recession and a lot, or the Great Depression, a lot of the really bad ones, you went into that with banks in a bad spot. And then, if the financial system doesn't have enough capital, then any little nudge can push it over and it creates this bad cycle. I think that is a big benefit we have of having a very, well-capitalized financial system. Beyond that, I don't really understand why all these headwinds keep not, if you look at we started a war in Iran, we, have had all this political chaos, we've had tariffs, we've had all these things which should have really caused problems and not. I mean, the flip side, you could look at it and say, hey, once we stop having these self-inflicted wounds, if we just don't attack anybody else, if we don't put any other, tariffs on the table, then, that will turn from not being a headwind. And so will we see growth from that? So although in retrospect, it will be obvious, I'm not convinced it's obvious today that there will be another downturn. So I am not, and to my point of like, I try not to outguess the market. I think the market hit another all-time high yesterday. And it's hard to say, okay, I'm smarter than the consensus out there. The one thing though, where I would say probably if something bad did happen, the biggest risk I see today is that the Iran and oil situation doesn't resolve quickly, because it's very interesting. I was talking with a big private oil guy yesterday. So he's probably doing 70,000 barrels a day, which is, pretty big as far as oil goes. And what I was asking him is, hey, we've had the biggest supply disruption ever to oil. We lost 10 to 15 million barrels a day thanks to the Strait of Hormuz being closed and, damage to infrastructure there, which is like 10% global output. And it's a pretty tight market. So how have prices not spiked much more than they have? And what he was saying is basically, if you look at the trading price, and basically the spot price of WTI, it has become fairly disconnected from the actual buying and selling price. Like if you really need a barrel of oil versus you're buying kind of a financial product that looks like one, they're starting to become stretched in terms of actual oil is more expensive to get than the markets are showing. And that especially it takes a few weeks to ship oil from the Middle East to customer destinations. But the last of that oil that was on the water before they closed the strait is now arriving in port. And so, the forward markets are telling us, hey, we think this will get resolved quickly. And if it does, it will be fine. But if for some reason the war continues to linger on for another few months, then I think you'll actually see a much more significant spike in the oil price. We've seen something very manageable going up to, max 115. It was $90 yesterday. That is not particularly high. It's high by historic standards, but that's not an outlier. But you could start to see those 150 or 200s if this doesn't change, because we are just drawing down inventories, across the whole developed world and across Asia. And so, that to me is probably the biggest risk, that this doesn't get resolved quickly. I think it probably will. The market says it was. If we've learned anything, that, we tend to kind of go right up to the line on things like tariffs or on things like the wars. And then when it's causing economic damage, pull back. So that's my base case. But if that doesn't happen, I think that could cause problems.
Yeah, that was really good. And I'm glad you unpacked it that way, because as you could kind of hear me laughing, in the background, like you were spelling me, like, all these things are happening. I'm like, I've seen this, I've lived this. This is what's typically going to follow. And then it didn't happen. And then we hit another all-time high. So like I mentioned earlier, I've just left a lot of money on the table. And, I'm hesitant to just kind of start pushing chips in. I need to start doing something, but I think that's where, like, your community, Long Angle, I'm going to keep coming back to that, getting around other people, sophisticated, high net worth individuals that are doing these things. Sometimes I think that's all you need, is just an echo chamber, just to hear it from more people. Like me hearing it from you gets me thinking differently. Just simple things like, hey, I'm investing in companies that are going to be around the next 10, 20, 30, 40 years. Contrary to what the pricing is and buying high, like, it's still going to be a good company. And when you do that, you start thinking like Warren Buffett, and you start thinking like some of these fundamental investors, everything just starts to be okay again. And you stop with that fear-based mindset, which I'm not going to lie, like, I've definitely been there. And, I've done well. I've done well with my companies. I just don't want to give it back. And that's my biggest fear. And I'd rather make 5, 6, 7% just kind of chipping away and just consistently do that, versus take the gamble, have the hit, and then all of a sudden, then I feel terrible about my decision. But
although
really
that's
good perspective.
know thyself is the most important thing to investing, right? If you do have that loss aversion, then you put in your money today and we drop 30%, you're going to sell. And that's the only truly bad outcome in investing, right? Is when you crystallize that loss. And if anybody tells you the market can't drop 50%, they're wrong about that. It has happened before, and it's going to happen again. So I think that's actually the key to good investing, is knowing what you personally can tolerate. And like, as I said, I've sort of learned over time that I'm somebody who doesn't mind the volatility, because I don't think it's permanent impairment. But if that's not your personality, then you're making exactly the right approach, because it'd be much worse to panic sell.
Good way to look at that. So, like, what is, we'll wrap on this, but like, what is the future for you? Like, what do you see Long Angle doing? I mean, do you have any big vision for like where it's going to go next in the future?
I mean, I think we want to continue to focus on this demographic of people. Again, let's call it first generation wealth creators. They tend to be on the younger side, mostly in 30s, 40s, maybe early 50s, in this kind of $5 to $100 million range. I think we want to continue to, build a community there, because I think it's sort of a unique set of needs. I wouldn't say it's, underserved in the sense of like, okay, nobody's feeling bad for these people. But I do think that they sort of have a unique set of opportunities, a unique set of needs. And so there's some stuff, like what we do, we've got a online community where people talk about this stuff. And then over time, we have found a handful of other things where people find collective power in doing it. So, one of it is in these private market investments. I know I came in doing, no private equity or no venture, no oil and gas. And we basically try and take advantage of both the collective scale and then the collective expertise, where we've got in oil and gas, again, you got a handful of people who either, run companies in the Permian, or their family's been in it for a long time. So kind of whatever that industry is for that asset class, piggyback on their connections and their expertise, and then just being able to collectively write bigger checks. So we do that. We're doing some, others. We do a lot of events and meetups and things like that. And so I think probably just continue to ask people, hey, what's the stuff that you feel is an unmet need? I think, again, I mentioned private placement life insurance. That's another one where I've heard about it. But if you dig into it, it's kind of $5 million minimums, but we do stuff as a group where it's like, okay, if we all come together, so we can go insurance companies say, hey, each person, we want them down to $1 million minimum, but collectively we're going to have $200 million here. So we want to, negotiate our collective rates aggressively. We're trying to do stuff like that to sort of take advantage of the scale to, meet whatever those kind of unmet opportunities or needs are.
I love that. I just had a gentleman who's been doing private placement life insurance for, gosh, decades. And he was talking about exactly how family offices are doing. It's, same thing you just mentioned, to kind of get a group of people in to be able to take advantage of some of that. I think that's a fantastic thing. But Tad, thank you so very much for your insight. This has been really good. And I appreciate everything you're doing. And I'm definitely going to throw in an application for the membership, do my little interview, and get around the campfire.
All right, I'd love to have you. Thank you so much for having me on here.
Absolutely. All right, folks. Thanks so much for joining us for this episode of Money School Elite. We will see you on the next one.